Financial markets can seem like this big mysterious thing, but really they're just places where people buy and sell things. What kind of things? Financial instruments like stocks and bonds. Why do we even need these markets? Think of it like this. Companies need money to grow. People want to invest their money to make more money. Financial markets connect the two. They provide a platform for this exchange to happen. Without them, it would be really hard for businesses to raise capital and for you to grow your savings. Financial instruments sounds complicated, right? But they're really just agreements that have a value. Think of it like a contract. These instruments come in different shapes and sizes. We have stocks, which are like tiny pieces of ownership in a company. Then there are bonds. These are like IOUs. You loan money to a government or company, and they promise to pay you back with interest. And let's not forget derivatives. These are fancy bets on the future price of something else, like a commodity or a currency. Let's say you buy stock in your favorite coffee shop. You now own a tiny sliver of that company. You're a shareholder. As the company makes money, the value of your stock usually goes up. Plus, you might get dividends, which are like little bonus payments. Of course, if the company doesn't do well, your stock value can go down too. That's the risk you take with any investment. Bonds are a bit different from stocks. When you buy a bond, you're essentially lending money. This could be to a company looking to expand or even the government needing funds for projects. In return, they promise to pay you back the loan with interest. It's a fixed income, which means you know how much you'll get back. Bonds are generally considered less risky than stocks, but they offer lower potential returns. Section 5. Derivatives. Betting on the future. Derivatives are where things get a little more complex. These are contracts that derive their value from an underlying asset. Think of it like betting on which way the price of something will go. Will coffee beans be more expensive next month? You can use derivatives to hedge your bets or speculate on future price movements. Section 6. Let's make a deal. The role of financial intermediaries. Now, you're probably wondering how all these transactions actually happen. That's where financial intermediaries come in. These are the middlemen, like banks, brokers, and stock exchanges. They facilitate the buying and selling of financial instruments. Think of them as the matchmakers of the financial world, connecting buyers and sellers and making sure everything runs smoothly. Section 7. Guardians of the market regulators. Of course, we need some rules in place. That's where regulators step in. Organizations like the Securities and Exchange Commission, or SEC, keep an eye on things. They make sure the markets are fair, transparent, and don't turn into the Wild West. They protect investors and maintain stability. Section 8. The dance of supply and demand. How prices are determined. So, how are prices of stocks, bonds, and other instruments actually determined? It all boils down to supply and demand. If a lot of people want to buy a particular stock, high demand, and there aren't many shares available, low supply, the price will go up. Conversely, if there's low demand and high supply, the price will drop. It's the basic principle of economics at play. Section 9. Risk and return. The yin and yang of investing. In the world of finance, risk and return are two sides of the same coin. Generally, the higher the potential return, the higher the risk. Stocks, with their potential for growth, are riskier than bonds, which offer more stability. It's essential to find the right balance for your risk tolerance and investment goals. Section 10. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. That's diversification in a nutshell. It means spreading your investments across different asset classes, industries, and geographies. By diversifying, you're less likely to be wiped out if one investment goes sour. It's a fundamental principle of smart investing. Section 11. The takeaway. Your financial journey begins. Financial markets can seem daunting at first, but once you understand the basics, it's not that scary. Remember, these markets exist to help businesses grow and individuals build wealth. Take your time, do your research, and remember that knowledge is power when it comes to managing your finances.